Imagine this, you're incredibly hungry and all you can think about is sinking your teeth into a delicious cheesy pizza. But there's a problem. You're short on cash, your wallet is empty and your pockets are bare. Just when you're about to give up, your friend Banky, ever the generous one, offers to buy it for you, a true act of pizza-loving friendship. He says you can just pay him back later, no big deal. That's essentially what a credit card does. It lets you buy now and worry about paying later. But just like with Banky's generosity, there's a catch, a crucial detail to be aware of. Because if you don't pay Banky back soon enough, if you let those days slip by, he's going to want a little extra each week, a small price for his initial kindness. Let's say a slice of pizza for every week you owe him. Suddenly that one pizza is costing you a whole lot more. That extra slice, that seemingly small addition, that's interest in action. Using a credit card isn't like getting free money. It's not a limitless resource. It's a loan, plain and simple. And all loans, without exception, come with a cost attached. The bank, in this scenario, is just like Banky. And the pizza represents whatever it is you decide to buy with that credit card. The agreement you make to pay those extra slices, that's essentially your interest rate, expressed in pizza. It's the price you pay for the convenience, the ease, of being able to buy something now and defer the payment to a later date. The bank takes a risk when they lend you money, trusting you to pay it back, so they charge interest to make the whole endeavor worthwhile for them. This is fundamentally how they generate revenue, and how they're able to continue lending money to others. Understanding this core concept is absolutely key. Credit cards are powerful tools, not financial traps waiting to ensnare you. That is, if you take the time to understand the rules of the game. Don't just focus on the immediate gratification of the slice you're currently enjoying. Always remember the potential cost, the whole pizza you might end up owing. Banky isn't just a friendly face offering you a favor. He's ultimately running a business, with its own set of objectives. If you don't pay close attention to the terms, your seemingly innocent pizza party can quickly become an unexpectedly expensive affair. Credit, when used responsibly, can be an incredibly powerful tool, but only if you truly respect the associated costs and potential pitfalls. So, what's the real trick to mastering credit cards? It's simple. Don't let those extra slices of interest pile up and overwhelm you. That's the key to keeping your pizza, and more importantly, your overall finances, firmly under your control. Interest is simply, well, it's a fundamental concept in finance. The cost of borrowing money. Think of it as the fee you pay for using someone else's funds. It's shown as a percentage, and this is called the annual percentage rate, or APR. This rate determines how much extra you'll pay on top of the original amount you borrowed. If your card has a 20% APR, it means that for every dollar you borrow, you'll accrue 20 cents in interest over a year. So, borrowing $100 for a year costs you $20. That's a significant amount, so it's important to be aware of it. But banks don't wait a year, they want their money sooner rather than later. Instead, they calculate interest daily and add it to your balance monthly. This means the interest compounds over time. The more you owe, and the longer you owe it, the more interest you pay. It's a snowball effect that can quickly get out of control. That $100 purchase grows a little every day, if you don't pay it off. The interest keeps accumulating, making it harder to get out of debt. Lenders highlight rewards and convenience, trying to entice you with perks. But they often downplay the growing cost if you carry a balance. It's easy to overlook the long-term consequences. Your job? Be smarter. Take control of your finances. Read the fine print and know the rules. Don't just skim it. Understand what you're agreeing to. Don't let the promise of easy pizza distract you from the real price. Those small purchases add up quickly. Interest isn't mysterious, it's just math. Simple calculations can reveal the true cost of borrowing. The longer you wait, the more you owe. Time is not on your side when it comes to interest. Understand the APR and you'll avoid surprises. Knowledge is power when it comes to managing your finances. Credit cards are useful, but only if you know how interest works. Use them wisely and responsibly. Don't pay extra slices for nothing. Avoid unnecessary interest charges by paying your balance in full each month. Here's where it gets tricky, and where many people get tripped up: compounding interest. If you don't pay Banky back, next week you owe for the pizza, plus last week's extra slice that you didn't quite finish. Now, interest is charged on your new, bigger total amount. That's compounding, paying interest on interest, which can really add up. At first it's just a crumb, a small amount, but over time it snowballs and gains momentum. For example, say you buy a $1,000 laptop at 24% APR, That's about $20 interest accruing in the first month. Next month, interest is charged on $1,020, not the original $1,000. Each month your debt grows faster and faster. Over years, that seemingly affordable $1,000 laptop could end up costing you $2,000 or even more. Compounding quietly inflates your debt over time. Most people don't notice until it's completely out of control. It's rarely one big mistake. It's the accumulation of small charges month after month. That's how a seemingly harmless pizza party can turn into a full-blown debt disaster. Don't let compounding catch you off guard and ruin your finances. Each month your credit card bill arrives. Your bill shows a minimum payment amount. It's a tempting tiny number. But paying just the minimum payment mostly covers interest charges, barely shrinking your actual debt. It's like paying for napkins while the pizza bill stays huge. For a $1,000 balance at 24% APR, a $25 minimum payment might only cut $5 from your debt. At that rate, you'll be paying for years and spend hundreds in interest. The minimum payment is designed to keep you trapped in debt. Lenders profit when you pay slowly. Don't fall for the illusion of progress. Paying just the minimum is a marathon you don't want to run. Break the cycle. Always pay more than the minimum. Want to escape the endless pizza party of debt and finally break free from those financial chains? The first step is simple. Pay your balance in full every month. That's right. No interest charges weighing you down. No extra slices of debt to digest. If you can't manage to pay it all, always pay more than the minimum amount due. The more you pay above the minimum, the faster your debt shrinks and disappears. This also means the less interest you'll end up owing in the long run, saving you money. It's crucial to know your APR and keep an eye out for those tempting 0% offers. But remember to have a solid plan to pay off the balance completely before those rates jump back up. To stay on track, set reminders on your phone for when those promotional periods are about to end. Always treat your credit card as a short-term loan that needs to be repaid promptly. It's definitely not extra income to be spent without a second thought. Before you swipe that card, take a moment and ask yourself, can I realistically pay this purchase off completely by the end of the month? Use credit mindfully and responsibly, and it becomes a powerful financial tool. It will not be a debt trap waiting to ensnare you. Remember, you're in control of the financial party, not the bank dictating the terms. Don't let those ever-climbing interest charges run the whole show and ruin your budget. Instead, make your credit card work for you, offering rewards and building your credit score. That's the true meaning of financial freedom, having control and peace of mind. So go ahead and enjoy your pizza without the lingering debt hangover afterward. Thanks for joining us for more helpful information from Make Your Money Last. Don't forget to subscribe, like, and watch the next video.